What if the biggest threat to the global economy, in a war, a pandemic, or even inflation, what if the real danger is something far more invisible? Something quietly growing for decades, hidden inside the financial system itself. Right now, the world is sitting on over $300 trillion of debt. That number is so large it's almost impossible to imagine. But here's the strange part. Governments keep borrowing more, banks keep creating more credit, and the system keeps expanding, even though everyone knows it can't continue forever. So, the real question is not if the system will break. The real question is, what happens when it finally does? To understand that, we have to go back to where this system really began. Because the story of modern debt didn't start in the last decade, it started over a century ago. Setting the stage, how the modern financial system was built in the early 1900s, the world economy worked very differently. Money was tied directly to gold. Governments couldn't simply create unlimited currency because every dollar had to be backed by a physical reserve. This system kept spending under control. But it also limited how much governments and banks could expand. Then everything changed. After the financial panic of 1907, powerful banking figures pushed for a new system that could stabilize markets and prevent future collapses. That led to the creation of central banking institutions like the Federal Reserve in 1913. At first, the goal sounded reasonable: manage liquidity, stabilize banks, and smooth economic cycles. But something unexpected happened. Central banks gained the power to influence money creation, interest rates, and government borrowing. And that changed the entire economic system, because once borrowing became easier, debt began to grow faster than the real economy. The origins, the birth of the debt economy after World War II, the global financial order was redesigned. In 1944, world leaders met at the Bretton Woods Conference. The goal was to create a stable international monetary system. Under this agreement, the US dollar became the world's reserve currency, backed by gold. For a while, the system worked, but there was a problem. Governments were spending more than they could support with gold reserves. Eventually, the pressure became too much. In 1971, US President Richard Nixon made a decision that would change global finance forever. He ended the gold backing of the dollar. This moment, known as the Nixon Shock, transformed money itself. From that point forward, currencies were no longer tied to physical assets. Money became fiat currency, value based only on government trust. And with that change, the era of unlimited debt began. The rise, when borrowing became the engine of growth. Once money was no longer tied to gold, governments gained unprecedented flexibility. They could borrow more, spend more, stimulate growth, and postpone economic pain. For decades, this strategy seemed to work. Every time the economy slowed, central banks lowered interest rates. When markets crashed, governments injected stimulus. And every crisis was solved the same way: more debt. The global system became dependent on borrowing. Housing booms were fueled by cheap credit. Corporate expansion relied on easy loans. Governments financed massive budgets through bond markets. At first, this seemed manageable, but over time, something dangerous began to happen. Debt started growing much faster than economic output. The world economy was expanding, but the debt supporting it was expanding even faster. The breaking point, when the system started cracking. The first major warning came during the 2008 global financial crisis. Banks had built massive financial structures on top of mortgage debt. When housing prices stopped rising, the system collapsed. Major institutions failed. Markets froze. Global trade slowed dramatically. To stop the collapse, central banks launched massive rescue programs. They slashed interest rates to near zero. And they introduced a new strategy called quantitative easing, essentially creating money to buy financial assets. This flooded the system with liquidity. Markets recovered, but the deeper problem remained. Instead of reducing debt, the world added even more of it. The fallout, the era of endless borrowing today, The global economy operates on a delicate balance. Governments carry enormous national debts. Corporations borrow heavily to finance growth. Households rely on loans for homes, education, and everyday expenses. The entire system depends on one assumption: debt must always keep growing. If borrowing slows down, economic growth slows. If borrowing stops, the system risks contraction. That creates a dangerous cycle, because the only way to maintain stability is to expand debt continuously. And history shows that no system can expand forever. Failed fixes, why the solutions don't work over the years. Economists and policymakers have tried many solutions: lower interest rates, stimulus spending, bailouts, currency expansion. But these policies often treat the symptoms, not the root problem. Lower rates encourage even more borrowing. Stimulus increases government debt. Financial bailouts prevent short-term collapse but create long-term risk. In many ways, these solutions are like adding pressure to a balloon that's already close to bursting. They delay the crisis, but they don't eliminate it. Modern parallels, the warning signs today. Many of the same patterns that existed before past crises are appearing again. Asset prices are extremely high, debt levels are historically large, and financial markets depend heavily on central bank support. Meanwhile, governments around the world continue running massive deficits. Every economic slowdown triggers more stimulus. Every crisis leads to more borrowing, and the total debt keeps climbing. History shows a repeating pattern. Debt builds, confidence grows, risk increases, and eventually, something breaks. The exact trigger is always different, but the underlying weakness is always the same. 3 key takeaways. So, what should we learn from this story? 1. Debt is powerful, but dangerous. Borrowing can stimulate growth and fund innovation. But when debt grows faster than the real economy, instability builds beneath the surface. 2. Financial systems depend on confidence. Money works because people trust the system. If that confidence disappears, even the strongest financial structures can collapse quickly. 3. Every debt cycle eventually ends. History shows that debt expansions eventually reach limits. The only question is how the cycle resets: through inflation, through economic contraction, or through financial restructuring. No one knows for sure. Final warning and open question right now: the world is experiencing the largest debt expansion in human history. Governments, corporations, and individuals are all tied into the same financial network, and the system continues growing. But the deeper question remains unanswered. What happens when the next major shock hits? Will the system stabilize again? Or will the debt structure finally reach its breaking point? Because if history teaches us anything, it's that financial systems rarely collapse suddenly. They weaken slowly until one moment reveals the truth. Call to action: if you found this story interesting and want to understand the hidden forces shaping the global economy, make sure to subscribe to the channel. And if you want to see more deep dives into finance, power, and the systems that control money, let me know in the comments. Because the biggest stories in the world economy are often the ones most people never see coming.